Okay, good afternoon. Today is Friday, August 25th. This is your weekly take on the market. I will be your host. My name is Scott St. Clair. I'm the manager of the Premium Product Group here at Investors Business Daily. Please take a moment to read the disclaimer. I'm not licensed. I don't make buy, sell, hold recommendations. We are allowed to trade freely in our own accounts, but we are under a compliance umbrella. So it's kind of a cool place to work. We all have skin in the game, so to speak. But I'm not licensed, so I can't tell you what to buy, when to buy, how many shares to have, what to do during earnings, et cetera, et cetera. Okay, so we'll do market thoughts. I'm going to skip the industry groups for the sake of brevity. Apologize, I've got a busy afternoon here, and it's about a quarter to the close, 15 minutes to close, trying to get this video out. I tried to do it earlier and just ran into a roadblock with meetings and stuff. So basically, the market's kind of done what it's going to do. So I'm going to skip the industry groups. We'll do market thoughts, and we'll do there's a bunch of stocks, and then we'll do the quote. So I feel like I showed you this quote before, or I should say this chart. And it's the National Association of Investment Management, I believe, and price drives narrative, not the other way around. People don't tell you they're bullish, and then they go buy, and then they tell you they're bullish. So as the price goes up, they get more and more bullish. As the price goes down, they get more and more bearish. As a general rule, right? Some of us, um, might have, as the price goes up, I tend to take some off, so to speak. But as a general rule, I want the price to be higher. It's why I look for stocks that are in new high ground, because if you have a stock that's in new high ground, there's not a single shareholder out there that's upset. And so there's really no kind of pressure to sell those names, which is why they tend to go higher. That's why stocks with overhead don't do as well. So this mini sell-off that we've had, I think it was about maybe 5 or 6% in the NASDAQ. We'll look at it in a little bit, has caused sentiment to decrease, which is good. It seems to me, I don't know if it's just me, but people tend to get bearish / cautious much faster than they used to. The dissemination of information might be one of the keys to that. Everything moves so much faster nowadays. There used to be an old saying in the futures game that you would the speculators would buy, then the investment houses would buy, and then they would sell to the dentists on day 3 or something like that. I kind of butchered the saying, but the idea was by the time the dentists heard about the corn going up or soybeans or S&P futures, then it was too late. And it was always seemed to be like, kind of a 3-day window, but it's not like that anymore. Everybody has the same kind of information so quick. AAII has felt the pain from the little sell-off we've had as well. The bulls have dropped almost 10%. The bears increased about 5%. And it's that spread which interests me, that it's very rare you get this close to spread and or more bears than bulls. So it goes to show that the price drives the narrative. As the price goes down, people follow the price, and vice versa. These are good things. You don't want too many people on one side of the fence. There's nobody to buy your stock from you later on. I think it was John Maynard Keynes or somebody said, you want the market to agree with you just 6 months from now, or for me, it's more like 6 weeks from now, but you get the idea. And there's a lot of reasons to kind of be cautious bearish. Here's the NASDAQ 100 ratio compared to the Russell 2000, highest it's ever been. So the outperformance of the NASDAQ 100, well, when I say it's ever been, based on this chart going back, 30 years roughly, you've got these alligator jaws of performance, and the Russell is just, the average stock has just not participated since we had our bear market last year. Here's another thing on the average stock. The 48% of all global stocks currently trading below their pre-COVID 2020 high. So the high that they made before COVID, half of them are below that. And you can see the chart shows you that kind of peak in that high. See AC all something world index, equal weighted index. And it's just the biggest, best. It's the NASDAQ tech. Those are the ones that are leading the market. It's another kind of strange year. It's the indexes have done one thing, the average stock has done another, and there's been some really good stocks and there's been some really poor ones. There's been some tremendous moves up and some stocks off the bottom, and some of them, never got off the mat. Like Peloton, gone, never got off the mat, but you had Carvana or Upstart, they tripled or quadrupled off the lows. So it's a good time to be a stock picker, actually. I think there's lots to be interested in, and it's not easy, but if you get it and get it right, they tend to reward you with really big moves, which is your risk reward. The asymmetry of that is pretty strong right now. We're in our seasonally worst period. This is a bad time, so we got to get through this. We're almost into September. And you got, I'm sorry, we're almost out of August into September. September is actually historically the worst month. I believe that's still the case. October is renowned for being the worst, but a lot of times the market bottoms in October. The bad stuff happens in the beginning or middle of October, and by the end, you've kind of made some type of low. I don't know what that means for where we are now, but the last quarter is seasonally best, and I've talked about at William O'Neill on the portfolio management side. It's really skewed. Like if this was their performance, that right side is gigantic. It's got some really big numbers over there, especially in December, because I think their December 1999 month was epic, epic, the performance. So just stay with it. You don't need to be a hero here. I think you can be long and or short. I am. That's how I like to trade. It doesn't mean I'm equally long and equally short, but I think that you can sort of be on both sides, so to speak. Okay, I apologize. I got distracted a tiny bit by the close. The market's about to close. I only have 2 positions, but there's one that I wasn't sure if I wanted to be a pig and add to it. So two longs and maybe one short or something. So we'll go over it in a little bit here. Foreigners love the U.S. market. From a contrarian standpoint, I don't know if I love this chart, but the money is just piling in to U.S. stocks, and it's partly because that's where the best performance is, the best stocks, the best names. I talk to a lot of clients overseas and that trade U.S. stocks. They live in the U.K. or in Singapore or Japan, and they trade U.S. stocks because they're just the best in breed. Mostly, not all of them, but mostly. There's some great international companies for sure. ASML and Tencent has been an amazing stock, and is it Naspers or in South Africa? I think they owned a bunch of Alibaba, or no, they owned a bunch of Tencent, I think, which helped their performance. But NVIDIA and on is all here. So I'm going to skip the industry groups. Like I said, let's jump into the indexes. So here's the NASDAQ, and it got stonewalled right at the 50-day, almost textbook. It's kind of strange. It's like, so perfect, so textbook. And then you had an outside day down. What's an outside day down? I don't know if you guys see that on Twitter a lot. It's where the high of the day is higher than the previous day, and the low of the day is lower than the previous day. And it's considered a bearish action. I don't know. Here's an outside day down here right there, and it worked for a day, but then that led to an epic run. I would say, go through and look at all the outside day downs. I'm not convinced it's a tradable thing. It's like anything; it might work once in a while. I feel like I've been short outside day downs and gotten run over the next day a number of times. So it's like, and this morning I was like, I had a few shorts, a little heavier on the short side. Market closed on right on the low, and what happened? Gapped up and ran, right? And it's caused me to tweet, I've tweeting, asking for a friend if we ever had a outside day down, continue lower. It's frustrating, but I wasn't that heavy short just because I just don't see that. Or as we sit here, I just don't see there any reason to be heavy long and or heavy short. So I was able to survive that. And then when, then you had the Jackson Hole news on Powell, and when you get that type of stuff, I if I'm short, I almost always cover. You have to be very hit and runish on the short side, in my humble opinion. It doesn't mean day trade it, but you probably don't want to. I sitting on the short side is just never paid for me. It just doesn't work that well. Day or two or three, or a week or two or three, gosh, that would be amazing to be able to stay like that. So it's usually a little bit hit and runish for me. The short answer is on the market is I don't know. IBD's got us in correction. We'll wait for a follow through day. I would, if I was back in high school and I had to debate whether to be bullish or bearish the stock market, I could debate either side. If he flipped a coin and I got bearish, I could easily sell the bearish side. I would win that argument in a second. And if I got the bullish side, I think I could easily argue that there's all the reasons that the market should go down are out there. The market knows the Fed's hiking rates a million times. The market knows China is in a deflationary spiral, and they've got these property issues. The market knows all of that, but yet here we are. We're not even making any kind of lows. I guess we kind of undercut that, but and not making a series of lower lows on the market. So that's my bullish case. The S&P looks very similar. It is below the 50-day, so you don't have to rush out. Russell looks terrible. I could be bearish to Russell. It just never goes anywhere. If we look at a monthly, it's up a little bit from 2018. It's just not, I don't know what makes up that index and why it's having a hard time. The average stock, then, as based on that kind of COVID, that Josh Hartnett tweet, is not acting that well. It's a very narrow market for sure. But if you only need to own 10, 12, 22 stocks, you ought to be able to find at least a few of them. And then you can be 60% invested. And one thing I'll tell you is you can do really well. And I run my cash accounts very, I don't know, laboriously. I don't know if that's the right word, but I concentrate on those big time. And I can't recall ever being like fully 100% invested. There's almost always some cash sitting around in that. So I'm never fully invested, but outperforming the markets over a long haul, not every week or every month, not even every year. But in the last 12 years, I can tell you it's been much larger than the markets. So, and that's not being, and the markets are always fully invested, which is one of their advantages, because when we're raising cash, then the market comes back and it's fully invested. So it's one of the advantages the market has. So when you have really good stocks and you have a 10, 12, 15, 17%, 25% position, if you're willing to go out on that risk curve a little bit more, you don't have to be fully invested, because you get stocks up 5, 6, 7% when the market's up 1%. If you have 10% of your money in a stock that's up 5% and the index, and if that same amount of money was in the index up 1%, that amount of money is up fivefold compared to what it would be in the index. You get the idea. So individual stocks provide a little bit of juice, which is why we're attracted to them versus the indexes. And the other thing I'll say about the indexes is Mark Ritchie, I should say, was on IBD Live this morning. If you watch IBD Live, I'd watch the replay if you have that. I like listening to Mark Ritchie. I've read his dad's books, and he works very closely with Mark Minervini. And he said something that I've totally wholeheartedly believe in. It's like, what would you do if the indexes didn't exist? Would you just give up? Would you just not trade stocks? So he said, if I see a signal, I'm not worried about what the indexes are doing. I just take it. I 125% agree with that. If I like XYZ, I'm just buying it if I want to buy it. If I think XYZ is a short, I'm probably just shorting it. I'm not going to worry about what the markets are doing. The problem is you have to kind of have one eye on the market, because the markets do move the indexes. You're going to kind of know where you are in the big picture, the big cycle. But unless it's really clear, like, then I'm not going to use that to make a decision. I can't remember the last time I ever looked at something and thought, I don't know if I want to buy this because of the market. I might reduce my size. I probably have done that, even if it's subconsciously, but I usually just buy it just in case, because I hate to miss it. What if the market gets better 2 or 3 days later and that stock's up big without me? All right, so let's go into some stocks, and I wanted to address kind of the stocks for the long run thing, which is it's important thing, and it's generally stocks do go up as a basket, but sometimes individual stocks run into a brick wall and just they become underperformers for a long time, and you have to kind of be aware of that potential. So here's Disney, topped at 200, currently 83. And I saw a guy tweet, I don't know if it was tongue in cheek, but he was like, this Disney's in trouble. This stock's going much lower, blah, 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 whatever. Made me think, well, when I saw that, I was like, well, I haven't looked at Disney in forever. Where's that stock at? And, it's down in half, and it's basically and I don't know what Disney's yield is or what it's been. It's probably it's none currently. But since 2014, you've made nothing. And think about all the great stocks that have occurred from 2014 to now. So there's definitely an opportunity cost in sitting if you don't pick the right one. We all remember the great ones, and I've had a few get away from me to the tunes of, big money. But I've also had tons of them that have gone away, and I've made my money and moved on, or took my small loss and moved on. Nike, I thought was very interesting. Topped in 2021, just doesn't look very good. I think Nike went down 11 days in a row. Somebody tweeted, I'm finally up today, but I have a friend who has Nike in his daughter's Coverdale account, and she picked it a long time ago because she picked Amazon and Apple products she used, and hopefully the Amazon and the Apples have done okay for her, because the Nike has done nothing. Not as bad as Disney, but in the last 5 years, no progress. And then last but not least is Intel. Because this was the great stock. This was the NVIDIA in the 90s, and they were eating AMD's lunch. AMD was like a $2 stock at the time. Yeah, $3, $4, $5, $8 stock, and just never went up, down, up, down, up, down, up, down. Terrible stock in the 90s. And Intel was the beast. And somewhere along the line, they obviously this caused an issue, but they never righted the ship like Microsoft did. And here you are, what are we looking at? 28 years of nothing. 28 years of nothing. And I have a good friend that works at Intel, and he did super well in the stock program here. And I don't know if they even have the same thing at this point, but but I think luckily for him, he made all his money already and was smart enough to diversify it a little bit. But it's just in hindsight, we think, well, Intel, it's not as good and all that. But go back, go back to the 90s. Intel was the best chip company in the world. They were eating everybody's lunch. So food for thought. All right, let's get to currently. NVIDIA is obviously on everybody's radar. Topped at 520 in the after hours and opened around 500. It doesn't look terrible. It did break out of a nothing, which I always say, if it breaks out of a nothing, you probably want to sell it. It's a little too short. But it's still above the moving average. The weekly looks okay. It doesn't look terrible. It looks a little bit distributive, but you've got a bit of a wall of volume here, right? So I don't know. I don't own NVIDIA anymore. I'm a buyer of NVIDIA on weakness, and 40 points from 500 is not enough. I think the way to buy NVIDIA for this foreseeable future will be on weakness. So, like here, like there, I even bought it like that. And if we get something like that, then I'll try it again. But I don't own NVIDIA any longer. I've moved on from that ship. VRT is my one long position, heavy long position. And I guess the data center numbers at NVIDIA were super strong because VRT, in the after hours, it was like 38 and had closed at 35.68. So I thought, oh, wow, I'm going to have a really good day in VRT. And you see it opened and just, gave it all back, which is what NVIDIA did. But then today, it really banged its chest as far as leadership. So this is my one and only long position, and it's outsized. I think this is a great leading stock based on the price action. We'll see. We'll see. What else is out there? In the oil and gas, still building the cup with handle. Tidewater, nothing wrong with it. Just for someone like me, it just kind of wear you out. NVO, acting really good. Lilly, wow, what a great stock, acting great. What else is out there that? Oh, the home builders. I think the home builders, at least short term, have topped. You've had kind of a bad break, although you did get a little bit of this. Toll had a great report right there, 59. Stock tried to go up and then came down. They look tired. Dream Finders, is that? I wouldn't short the home builders. It's too soon to be short them if that's kind of your thesis. But I think there are sells as far as longs. And if you don't have, and otherwise you just kind of wait it out and see what happens. That's it. There isn't a lot going on. I think it's a time to be fishing. I don't go fishing. I don't play golf like I used to. There'd be a time to play golf. I do miss playing golf, but it'd be a time to go fishing, time to play golf. And it's just a time to be small, I think, in the market. You have some stocks you don't want to sell, you want to be long, you think they're going higher. I think that's fine. But I don't see any reason to be 80, 90% long, or gosh, using margin at this point doesn't seem very prudent. I don't think. Okay, let's go to the quote of the week. Real simple. I think it's my smallest quote of the week ever, and it's the get smaller, get smaller. And I don't know if you saw, there's somebody reached out to me and asked for an interview. Stock Obsessed, I think, is his Substack, and he asked me about, how do you handle drawdowns? And I said, well, I'll steal Marty Schwartz's quote: get smaller, get smaller. So if you're in a drawdown here and you're struggling, just get smaller. Reduce your position size, reduce your positions, it's such a great time. You don't have to pay any commissions. I understand the whole tax thing. Let's pretend that doesn't exist just to make it easy, but it's so easy to get smaller and or get larger if you want, slowly but surely, because there's no commission. I used to pay $30 a trade for my own trades, and I would sometimes do 60, 80 trades a week. This is bananas in the 90s. I was going crazy. Everything was moving. I didn't, I was shoot first, ask questions later. And the commissions were large. They could eat you up doing that. Now there's zero. So it's easy to get smaller and get smaller. So when Marty Schwartz, he was having a tough day in the market, his wife, who worked with him at the time, he came in and she knew he had a lot of exposure, and she just kept saying, get smaller, get smaller. What great advice. Man, she must be really sharp, because she knew it was going to be very difficult for him to get out. Like, that's the thing. A lot of people ask me, what do I do if XYZ gaps down? Well, most of the time you just want out immediately, but it's so hard to do psychologically. So I say, get smaller, get smaller. Stevie Cohen tells his traders, or used to when he had a bunch of traders, if you have a position that's hurting you, cut it in half. Okay? Just cut it in half. And then if it keeps hurting you, cut it in half again. Right? And at that point, you're down to 25% of the position. And at that point, it probably is kind of a hard time hurting you, even if it does keep going down. So you cut it in half, still not working, cut it in half. Now you have 25% of your original position, and now you can evaluate. Probably don't want to cut in half a third time. I think at that point, you just move on, just get out. But same concept, get smaller, get out. Cut it in half, get out. Okay. All right, everyone. Thank you. I've got to run. I've got something I got to get to here. So I appreciate your time. Next week is the Stay in Step webinar. So I don't believe there'll be a video next Friday. Marcus Smith at investors.com, 800-424-9033. Have a great weekend, everybody. Bye-bye.